The Federal Reserve Bank just finished their two-day meeting and they gave us 5 different announcements. Number 1 is that they are not raising interest rates right now, but they might be in the future. Number 2 is that inflation is more stubborn than originally thought. Number 3 is that our economy is growing faster than expected. Number 4 is that jobs are growing slower than expected. And then number 5 is that the high bond yields could cause more pain in the economy. However, the Federal Reserve Bank is kind of unsure as to what's going to happen with this. So what I want to do in this video is go over these 5 items one by one. And if you stick with me until the end of this video, I'll show you how you can get a copy of this ebook, How to Build Wealth as an Investor, for free. My team at Briefs Media put this together, and I'll show you how to get this ebook at the end of this video. Now, starting with point number 1, which is that the Federal Reserve Bank is not done raising interest rates yet, but they're not raising interest rates right now. What they said is that they're going to keep interest rates where they are currently, which is 5.25% to 5.5%. That's the federal funds rate. This is not mortgage rates. This is not your car loan rate. This is what the Federal Reserve Bank sets as interest rates. And this is the interest rates that then banks will charge one another when they lend each other money. So you can think of this kind of like the wholesale rate for money. If the wholesale rate goes up, the retail rate goes up, which is then your mortgage rate, your car loan rate, and everything in between. But the Federal Reserve Bank said that they are not raising interest rates right now. Then Jerome Powell, who's the chairman of the Federal Reserve Bank, was asked, are you planning on cutting interest rates anytime soon? Because a lot of people are kind of getting anxious about when our mortgage rate's gonna fall, when our car loan rate's gonna fall. And what Jerome Powell had to say was this, quote, the committee, aka the Federal Reserve Bank, is not thinking about cutting interest rates right now at all. Instead, the question is, should we hike more? So Jerome Powell says, don't worry about cutting interest rates right now. We're not thinking about cutting interest rates right now. The only thought on the Federal Reserve Bank's mind is, should we raise interest rates more? Which brings me to question number 2, or their second announcement, which is that inflation is more stubborn than originally thought. Remember, the Federal Reserve Bank wants to bring inflation down to 2%. As of our most recent report, core inflation, which is the way that the Federal Reserve Bank measures inflation, is currently at right around 3.7%. So almost double the Federal Reserve Bank's target. Now, the Federal Reserve Bank said that there's some good news that they've been seeing core inflation start to cool down in the last number of months. However, bringing it from where we are today to 2% is going to take more work. And that means keeping interest rates high and potentially raising interest rates some more. What Jerome Powell then highlighted, which I think is where people get more intrigued on this, is that there are concerns about inflation because of how strong the economy is. What Jerome Powell said is that the above trend growth for the economy and the strong growth in the job market could lead to more inflationary pressures and lead to more potential rate hikes. Meaning, we have the strong economy. People are spending money. We are seeing still a lot of jobs out there, a low unemployment rate. These things in a healthy economy would be good. But what Jerome Powell, who's the chairman of the Federal Reserve Bank, is saying is, right now, that's not a good thing. Because if everybody has a job, and if you're seeing wages rise, and if you're seeing all these strong economic numbers, that's bad news for inflation, which could lead to potentially higher interest rates, which means higher mortgage rates, higher car rates. This brings me now to number 3. You'll see how each one of these tie in together. That the economy is stronger than expected. Recently, in the last couple of weeks, we got the latest economic report showing that our US economy, the GDP, grew faster than expected. And it shows that people are spending more money than what they're making. This is a line from Yahoo Finance. By the way, I'll link this article for you in the description as well. But what it says is that new spending data out of September showed that consumers, Americans, are spending more money than they are earning. Adjusted for inflation, consumers increased spending in each of the last 3 months, while real disposable income fell over that same period. In other words, what we have been seeing happen over the last number of months is that spending has been growing faster than people's incomes. Now, what does that mean? That's good for the economy, because if everybody's spending all their money, if everybody's going into credit card debt, if everybody's pulling cash out of their homes, if everybody's digging deep into debt to spend money, it's good for the economy. because that means Gucci makes more money, it means Chipotle makes more money, it means Louis Vuitton makes more money, it means Target makes more money, it means Amazon makes more money. You get the idea. When people spend more money, even if you don't have that cash in your account, it's good for the economy because it keeps the system moving, and it keeps banks in business as well, because that means banks get to charge you interest. However, the concern here is, when will that spending slow down? Because eventually, if people keep spending more than what they're earning, and if they're spending faster than their wage growth, eventually you're going to hit a breaking point where you cannot keep spending more money. Now, when will that breaking point come? Everybody has a prediction. A lot of banks are saying that we're going to see that at some point in the second quarter, meaning the middle part of 2024. But only time will tell. Now, of course, we're seeing more and more people struggle with spending because, well, now you have student loans. We still have all this cumulative inflation, because inflation isn't a one-time thing. We're building on top of last year's inflation and the year before that inflation, and it's still hotter than expected. So the prices of things are still rising faster than incomes, and that's on top of last year's crazy inflation numbers, and that's on top of the year before's crazy inflation numbers. So you have to imagine that eventually there'll be a breaking point. And you're seeing more and more creative ways for people to spend money. I talked about recently, there was a credit card that I just saw in an advertisement that allows you to spend money that you have in your home equity. It was a home equity credit card. A very dangerous tool, but you can start to see people are getting more desperate, because if you own a home, but you can't afford your lifestyle and you have some equity in your home, you want to be able to maintain your lifestyle. So what are people doing? Well, now you're seeing people swipe to spend their home equity. You're seeing people pull out these home equity lines of credit. You're seeing people go deeper into credit card debt. Credit card debt just broke a new record high in order to maintain their lifestyles. But eventually that will hit a breaking point. So yes, we are seeing a strong economy because people are spending, but there's a lot of red flags with that you want to pay attention to. This brings me to number 4, which is an interesting point, which is that the Federal Reserve Bank noted that job growth and wage growth is slowing. What they said about job growth is that currently our unemployment levels are at 3.8%, which is still historically very, very low. However, what we've been seeing is that month over month, unemployment has slowly been trickling upwards, slowly been moving upwards. Now, we're still at a very low unemployment number. But what Jerome Powell said is that, quote, employment gains have moderated since earlier in the year, but remain strong. So the question is, are we going to continue to see a weakening in the job market? And the reason why this matters is because, like Jerome Powell was saying earlier, when you have such low unemployment and you have such a strong job market, it makes inflation worse, which leads to higher interest rates. Now, every person in America wants a job. Every American consumer needs an income, but you're trying to balance the economy and economic growth with inflationary growth. And what the Federal Reserve Bank's trying to do is they want to bring inflation down. And that's why they're saying they want to soften the labor market. What does softening the labor market mean? It means less people have jobs, and it means less people see wages grow. Because if your wages stop growing, you're not going to be able to keep spending more money. And if you can't keep spending more money, you're not going to be able to go to the store and buy more stuff. And if you can't go to the store to buy more stuff, that store is going to be forced to not raise the prices of their products. And that's what the Federal Reserve Bank is saying is going to help solve that inflationary problem. And you can start to see where that causes economic pain. Because if you're not seeing the wage growth, that also might mean that maybe you have to move to a smaller apartment. Maybe you got to downsize your car. Maybe you got to buy less stuff. And that causes economic pain. So what is that going to actually cause? Well, we don't know, but this leads me now to point number 5, which is the high bond yields leading to more concerns about our economy in 2024. And what the Federal Reserve Bank is talking about here is more specifically Treasury yields. In other words, when the United States borrows money, they can borrow money from you, me, governments, the Federal Reserve Bank. They borrow money because we have this national debt. That's money that the government is borrowing. Well, the interest rates now that the government has to pay on these treasuries, these government loans, are rising. Why? Because the Federal Reserve Bank is raising interest rates and because people are concerned about inflation and our economy. So what we've seen happen in 2023, especially over the last few months, is that the yields on these treasuries have shot up. to some of the highest levels that we have seen since before the 2008 crash. Now, why does that matter? Because the person who has to pay these loans back, is the United States government. And the person who funds the United States government is you, taxpayers through tax dollars. And so this poses a concern because now as treasury yields rise, that also makes borrowing money for your mortgage more expensive. It makes borrowing money for your business more expensive. It makes borrowing money on your credit card more expensive, which can cause more issues in the economy. Here's what Jerome Powell had to say, quote, "Tighter financial and credit conditions for households and businesses are likely to weigh on economic activity, hiring, and inflation. The extent of these effects remain uncertain." So essentially, these higher treasury yields are going to pose an impact on hiring, the job market, the economy, and inflation. What impact is it going to make? We don't know. That's what the Federal Reserve Bank is saying. And this is where, again, I keep saying, 2023 is not the year for you to go out and finance a new truck. 2023 is the year for you to get financially smart because there's a lot of different things happening. And the Federal Reserve Bank is saying that they want to keep interest rates higher for longer, maybe even raise interest rates more, which is going to create some sort of impact on the economy. And this is what the Federal Reserve Bank is saying, that impact is uncertain. Now, could that cause economic pain? Absolutely. But that also creates opportunity. And that opportunity is for those who are financially educated and prepared to be able to capitalize on those opportunities. And that's why I want you to not only understand what's happening, but understand how you can protect yourself financially and capitalize on investment opportunities. That's why my team at Braves Media wrote this ebook, How to Build Wealth as an Investor. I told you in the beginning of this video, if you watch until the end, I'll show you how you can get a copy of this ebook for free. If you want to get a copy of this ebook, all you got to do is click the link down in the description below or go to briefs.co/ebook and you can grab a copy of this ebook for free. It goes over things like how do you start investing? How do you save your first couple $1,000s? What are the different ways that you can invest your money? How do you generate cash flow? How do you spend your money smartly? How do you earn more money? And how do you protect your assets? A ton of value in this ebook. Grab a copy of it for yourself. Now, in addition to that, this is where you also want to be prepared. Not only building that financial education, but also building the preparedness, meaning you want to have cash to protect you in case something bad were to happen to your finances, but also capitalize on financial opportunities that might come your way. Because you could have all the financial education in the world. You could see an amazing investment opportunity. But if you don't have any money to capitalize on it, you can't actually get any of those rewards for yourself. And that's where now you want to build that financial education, work to build that financial preparedness. 2023 is not the year for you to finance a new truck. You're seeing used truck prices fall. 2023 is the year for you to get financially smart because, well, we could see more opportunities next year and the year after that, but you want to make sure that you're protecting yourself first before you make everybody else around you rich.